Good morning. Can you hear me? Can I assume that you can hear me? Okay. If you need me to talk louder, I don't know how I'm going to shout. Okay. Good morning. Yeah. My name is Anthony. I am not on the sell side. Yeah. I hate sell side because I started at sell side, giving ideas to con people every day, what to buy, what to sell. Now I'm on the buy side and I give you my honest opinion. Yeah. You decide. Okay. See, they don't want me to talk anymore. Okay. This is the most important chart. Please read it. Okay. Thank you. Okay, now I will share with you what I would do in the market if I'm investor today. Okay, yeah, you know the whole world is going down. Not exactly, but in this part of the world, in the Asia, you look at the chart that we have from Asian Development Bank, updated as of 25th of September. Okay, just zero in on the arrows, they are all down. Okay, no need to ask question, no need to think anymore. They are all down. You look at the stock market, the indices, for those of you who have not looked at chart for a while, they are all down. Very, very down. Okay, the whole is going down. Yeah, STI index dropped more than what you think about Hong Kong, for example, or Malaysia, for example. You look at from a different perspective, we are essentially going back to 2011 days, 2012. Yeah, so if you look at the chart, it doesn't do anything for us for the past 3 years. Waste of time. Yeah. You look at from another perspective, from the same starting point. Yeah, we have been very fearful of Hong Kong, for example, the last few months. Okay, but you look at our chart, Singapore has actually dropped more. Malaysia has dropped more. Yeah. So I'll come back to this in a short while. Singapore, look at the 2-year basis, okay, 3-year basis, sorry, 2012 to now, 3-year basis. In terms of variation, we are cheap. Okay, at least compared historically, we are cheap. Yeah, slightly below 13. Is it truly cheap? Okay, I have been also reading what the analysts and the broking houses are saying, both local and foreign houses, saying in terms of price to book, for example, we are cheap as of now. Okay, but you know, PE is only one factor. When you buy anything, you must look in terms of not just PE, but price to book, not just price to book and PE, but also market sentiment, not just sentiment, but also growth. What do you buy for? What do you buy for? Do you buy because it's cheap and lock up for 20 years? Or what you buy for? You want to collect dividends, you see the share price go up, right? Okay, Malaysia. Malaysia is getting very cheap because can tell you the Malaysian companies are still growing up very nicely, especially the small cap and mid cap. A lot of values out there to pick up in Malaysia. If you are concerned about ringgit, I will also be concerned about other currencies. Okay, so you look at Malaysia itself, I think it's getting very cheap. Thailand has been fairly resilient. They live in a world of themselves sometimes. But if you look at the comparison, if you want to look for market timing to buy, I will touch on the wall. This is giving you value as well. And Hong Kong is giving you one of the cheapest in the region. Yeah, the PS now is just about less than 10. Yeah, historically it's very, very cheap. And if you're buying to the growth of Hong Kong and China, this is a place to find value. Now, China, okay, before I touch on the market strategy, I'll touch on China. China if you read the papers, the manufacturing side coming down, service side contracting, manufacturing contracting, not coming up, contracting. Okay, so we are all looking at China in contraction mode. Okay, I touched on this morning and share thoughts that let's wake up. I don't think we should be reading reports that we expect 7%, 8% a year every year. Yeah, China has now becoming very, very big. Back in before 2008 crisis, I remember reading various reports, economists, brokerage houses included, saying that by the year 2020, I think China economy will overtake US. Yeah, I think this is the time where us to look at assumptions again. Yeah, now that the pie is getting bigger, the economy is getting bigger. Do you truly expect that the economy will continue to grow 7 to 10% a year every year? Yeah, I think this is the attempt for us to reflect on ourselves and our expectations, both in terms of brokerage houses and economists. US growing nicely. You might have read reports from time to time that numbers are not within expectation, slightly below expectation, whether it's no claims, whether it's retail sales, for example. But you look at the big picture, unemployment rate is coming down, inflation rate is low. So as far as the Fed is concerned, the economy is doing well. Notwithstanding the volatility as comments about how the likes of what's happening in China may slow down growth in US. Okay. To put it short, I think the ingredients are such that I think they will raise rates. I changed my view slightly from this morning. Okay, instead of saying that it's either October 28 or December, I'm more convinced it's most likely to be December 16. Yeah, because by raising rates on December 16, it also does not rock the US retail sales for the Christmas season. Yeah, so nobody needs to be rocked. Okay, life moves on once you raise interest rate. But don't bet anything. It can be October 28, the blood moon, or it can be December. I don't know. I don't think you know. Okay, so let's move on. It's going to be either October 28 or December 16. Full stop. No third option. Okay, and the best scenario that we are likely to see is that, and the scenario that we are likely to see also is that they raise rates and they make a comment that rates are not likely to be increased in the next session. Yeah, what it means is that there'll be no cockroaches. It doesn't mean you have one rate, you continue to have another rate. Okay, it's not likely to happen. Cockroaches are dead now. Okay, there are no cockroaches. As far as the Fed is concerned, they will raise rates once this year and freeze, and that is good enough as far as investors are concerned. Okay, it's a clear signal that what they need to do in the last 2-3 years they've been talking is done, and things are improving, and we pick up from there, and that reduces the market volatility, and global equities probably pick up again. Okay. So what's the strategy? I think as far as I can see, okay, if you are holding back your money, waiting for the best time, please give me a call and tell me where's the best time. Okay. I don't think you know. I don't think anyone can really know. One way is for people to look at the charts and say, oh, the chart tells me so. I don't share the view. Okay. I look at it in terms of what's happening now. We have a situation whereby the global economy is still growing. China is growing. The bubble has burst, full stop. Okay, as far as the Chinese markets are concerned, it will take time to go back to where it was. Yeah. But as far as the economy is concerned, the economy was continue to grow, the Chinese authority have to continue with its reform, what it wanted to do to shift to a more consumer-based economy. That must be continued. Okay, so there'll be some restructuring in the economies. The beginners, there'll be people, losers, taking more pains. The property side market, for example. Okay, but as far as China is concerned, they want the property market to stabilize. They want the economy to stabilize, and this will continue. Okay, so to a snapshot, I think the global economy is improving, is intact. Europe is improving. China will be all right. So what are we waiting for? As far as our regional markets are concerned, uh, the market has been priced in. Okay, the market has been priced in. You look at Singapore, for example. Early next month, you will know without having to guess at all that Singapore is in a technical recession. Full stop. Okay, this has been priced in by all investors. Yeah, all investors. So if global investors wanted to downgrade us to reduce the exposure to this part of the world, they have already done so. Yeah, so basically what we are looking at is a series of events coming out, which is nothing major to be looking forward to as of today, but we are looking at market stabilizing. Okay, so what I will do as an investor is that if I have extra money waiting to buy, okay, I will put in half first, or if I have more, I'll put in 1/3 first. Then I will reassess when the market stabilizes more, share prices stabilizes more, I will buy more. Yeah, as of today, I'm really seeing value in the likes of Hong Kong, in the likes of Malaysia. Yeah, forget about the Chinese speculative counters. There are a lot of companies which are well run, giving good dividends. They are giving very good value based on price to book and price to PE in Hong Kong, based on price to book and PE in Singapore. Established companies. But you look at the middle to small cap, there are many companies growing in Singapore and Hong Kong as well. And in Malaysia, the mid caps companies are growing, having well-run profits coming in and good cash flow. Okay. If you want to zero in on Singapore, if you ask me what do okay, I will give my personal view. I'll leave it to you. I will personally pick up steady companies that are giving good dividends, the likes of ST Engineering, the likes of SPH, for example. Yeah, you think they are cash cow. Okay, so sometimes they are cash cow because they are not as growing, but they are nice. Like it's a bit of my poems. Okay, you think it's not growing, but it's a cash cow. Okay, a few hundred million coming in every year. Yeah, and are able to pay you dividends. Okay, if you're looking for value longer term, I like the banks, for example. Okay, I wish I can buy DBS at $2, but I don't think I have the appetite to wait anymore. But I'll probably buy DBS today, and then I hold back about 2/3 of my money and to buy more if in the event that it went higher, it goes higher, I can average up, not necessarily down. Yeah, so the banks are a good one. And now what I mentioned this morning, the commodities company, everyone is scared about commodities. Commodities have tanked ever since the rise of China slowing down, even back in 2011. Okay, but I see good values there. For example, Wilmar. Okay, one of my colleagues said it'd be good to share some news. So my personal, I share some news of Wilmar. The price now is about what, 260. If you look at the book value, it's about 240. Okay, so you have the book value to back up the share price. So why am I frightened? Why am I frightened to go in if I want to take a long-term view? Okay, anything else? Richard, what did I say this morning that I can share with them? Okay, morning again. Wow, I have specific questions now talking about sector and stocks. Okay, I'll touch on the first one. Which sectors in Hong Kong and China are you currently seeing good values, as you mentioned earlier? I think basically We have utilities, good utilities companies, Chinese companies listed in Hong Kong. Yeah, I think these companies are actually expected to continue to do well um, in their businesses. We also have the likes of companies which are okay. I just mentioned one. Okay, for example, I come across Pax Global, which are into manufacturing and sale of point of sales equipment. Okay, these are also expected to do well, and yeah, I think the market is basically consolidating to give us a chance to buy some of these good companies. Okay. Second question, what is your view on REITs sector? You're asking the wrong person. I don't like REITs for ever since I was born. So if you are looking at the interest rate environment going up, uh, it's not the right time for me to look at REITs. I would prefer to look at companies which have been growing nicely and paying good dividends. And the dividend yield in the Singapore market now, for example, the blue chips, many of them are paying about 3.54% dividend yield. This is better than what I can get from REITs if I were to invest in REITs. Yeah, hope I answer you that. Okay, I share with you one REIT I personally like. This is Verige Health Trust. It's listed in Singapore, but it's under the Fortis Group, and they own and manage a chain of hospitals in India, various parts of India. And because they are in the Fortis Group, uh, if Fortis want to, Fortis can actually inject more hospitals into this grid. Okay, so the IPO, I think it was about 90 cents. Now is uh, just about that, not much more than that. Okay, yeah. Anything? No question. Can I move on to the next one? We have a few questions today. What about net operating loss for the long term? Sorry, I don't buy into losses. They better change the name first before I buy. Fourth question, would it be better to wait till the Fed raise rate in December? My answer, Mr. Lai, is that no. Okay, because in life, in stock market, uh, you can be ultra, you can be ultra at any one time in terms of investment strategy. At any one time, say no, I don't like risk. Let it subside first, then I buy. Or I'm concerned about China economy. Let it grow first, then I buy. I'm concerned about US rate. Let it raise rates, then I buy. You'll always be late. Yeah. So if you are okay, if you don't mind, say buying at 20% higher, 15% higher. And for the market, in terms of translation to share prices, it can be much more than 15, 20%. That's a different story. But investment strategy should be you assess a situation, you make a best judgment. Okay, you ask yourself what could be the downside, what could be your risk in the event you're wrong, how much will you be hurt? Yeah, given that scenario, currently I don't think we will hurt ourselves very much. Things are stabilizing. Okay, if you want to buy because you think things are stabilizing, but you're not sure about the Fed, you put one third first. Then after the Fed has risen, uh, there might be some knee-jerk effect. Then you can move on. Whether you can catch a knee-jerk or not, I do not know. Then you can add on another third. That might be one way, Mr. Lai, the way I see it. Okay, hi. They have unmuted me. Okay, the next question. Which of the three local banks is safe bet, bearing in mind slow growth in China and Singapore facing technical recession? Singapore doesn't face technical recession. I want to correct you. Singapore is in a technical recession. Full stop. Okay. Uh, so if you're looking at Singapore and China, I think as far as our local banks are concerned, they are not just into China and Singapore. They have substantial exposure to the likes of China, yes, and also substantial exposure to the likes of Malaysia and Indonesia for two of our bigger banks. Um, if you are looking at the banks, I find personally all three banks I'm okay with them if you ask me. Okay, OCBC, if you look at the price range, for example, or for the past many years, the $8 has been a good support. The $10.50, for example, has been a very strong resistance. Yeah, in terms of DBS, uh, basically um, the franchise is still very strong, even in Hong Kong and China. And uh, I think the banks is not just all about China. You also have this part of the world. When we rebound, we can rebound very strongly, including Malaysia, Indonesia, and uh, Thailand. So if you ask me, OCBC is traditionally a safe one. DBS is can be what I call widely exposed because when foreign banks look at banks, they zero in on DBS. But at current value, I think it's giving good value among the three counters. Okay. Just one thing to tell you about banks. Historically, the banks in Singapore, the price to book, for example, has uh, before the global financial crisis, DBS price to book was about 1.7, CBC and UOB price to book about 1.4 each. Currently, all three banks are giving you price to book just about 1.1, 1.2 times. Yeah. So historically, actually, all three are fairly safe.
De Hong here. There's a question on First REIT. So for First REIT, when we initiated on it, we played on the fact that First REIT was actually banking on this macro theme for Indonesia in that they're launching this new healthcare, universal healthcare insurance, and we expected it to drive the healthcare demand in Indonesia. So for now, until now, since we initiated, the macro picture is still intact. As for First REIT, I think going forward, when people buy REITs, one of the primary concern would be when interest rates go up. How would the impact be? But for First REIT, I think the impact would not be as great because they've been pretty prudent, as with most REITs after the GFC. So for First REIT, they have had about close to full, about 95% of their debt is on fixed interest rates. So there will be no increase in interest costs until they refinance the next debt, which is only in 2017. So on that note, with increasing interest rates, they will not be seeing any increase in financing costs unless, of course, if they take on new acquisitions and from there interest rates start to go up. But for current debt, not until 2017 because that will be the time where they next need to refinance their debt. So, and with the recent change in the MAS ruling that REITs universally can only go up to 45% in gearing, previously because First REIT did not have any credit rating. So the old rule was that no REITs without credit ratings you're only allowed to do up to 35. So previously, First REIT was on 35% cap limit. So currently they're doing about 32%. So with the new ruling, they will be able to go up to 45% from the current 32%, which will be a good thing for First REIT. And then the thing about increased interest rates and for First REIT is also that yes, increasing interest rates will lead to increasing costs for First REIT. But if you look at the previous acquisitions that they have done, from they have acquired from their sponsor, the Lippo Group, you see that most of the rental yields that they have achieved at acquisitions were doing close to 10%. So even if we were to factor in a rise in borrowing costs, I think there's still a big buffer for them in terms of the kind of accretive acquisitions they can do. So yes, interest rates may be going up, but then I think if you're looking for a stable story to play on, a very defensive healthcare team in Indonesia, and because they have long wheels as well, over 10 years, their leases are all pretty long term with 100% committed occupancy. I think if you're looking for a safe defensive bet, you shouldn't look any further than First REIT.
Hi, morning. Okay, a question here. Commodity sectors. How do you view the mining iron ore sector? Are we still in the midst of a long downturn? What indicators do you look at? What's that? What indicators do you look at that can suggest an upturn? Phew. Well, that's a tough question, to be honest. But I think generally speaking, when you talk about mining, uh, when you look at the Chinese economy and the global economy, we don't look at the gold and silver metal, precious metal. You're looking more at the likes of your copper, your coal, your iron ore. Yeah. So essentially, the outlook for this is essentially very simple if we simplify it. Okay. Uh, in general, they are still in the downtrend because of China. Yeah. And we can only expect that they will recover when the Chinese economy picks up again. Okay, I think essentially these are the indicators to look at when you are looking at whether it's actually upturn. But what I shared is essentially if you look at the likes of the uh, plantation companies, commodity companies, you take a 3-year view, they're actually giving us good value, like Wilmar I mentioned. Okay, it's a integrated downstream, upstream company, very strong in that sector, and you have book value to back up the counter as well. Okay, then there are other companies like this as well. Okay, let me just jump in, for example, to another question, which is quite similar. Can you comment on the offshore and marine sector? Huh? Sorry, the research people don't cover it. So okay, yeah, okay. Our research guys say they don't cover. Okay, but just let me share my thoughts lah. Okay, the offshore and marine it's all in the news. Okay, oil price as to today is just about 45-ish US dollar per barrel. Okay, so how do you see a recovery as far as oil price is concerned? Essentially, is uh, if you ask me to stick out my neck, it's not supply and demand per se, but oil price can only pick up when you have a pickup in global economy. Yeah, okay. The reason why we have a drop in oil prices is essentially the global economy has slowed down. China has weakened. Okay, so if we were to see a more meaningful pickup in oil prices, the global economy has to pick up. Then the OPEC, not OPEC supply, they will take care of themselves in due course. Yeah, I think as far as the US are concerned about oversupply from the non-traditional sources, um, that has been put in the back burner for a while now. I don't think we have been reading about that and whether or not they can continue to provide this shale gas. I don't think we are overly concerned for the time being. What we should be concerned now is that global economy should pick up, then oil price can pick up. Okay, and if you look at the sector, your question mentioned Sembcorp and Keppel, for example. Okay, I think as far as Sembcorp and Marine is concerned, they are actually still having contracts, but the type of contracts will also vary from time to time depending on the customer's outlook for the sector industry. But both companies are actually having very strong order books. Okay, and they'll be around. So I personally see longer term value in both these two counters. Okay, yeah, good afternoon. Okay, coming to noon. So my colleagues say that there are a lot of questions and some the field research don't cover, like for example, Novel. Capricorn, I mentioned my take, although research doesn't cover and ONG as well. Okay, I'll take one last question, the question of what is the outlook for the China market. Okay, China market bubble has burst, full stop. Okay, as far as the bubble is concerned, it's lost. It has burst, and that has affected the Hong Kong market. Okay, but because you saw the chart earlier on, but because our Hong Kong market has gone up earlier, year to date is actually slightly doing slightly better than the Singapore index as of end of last week. Now, as far as the Chinese market is concerned, uh, it will take time to recover. So I would prefer to zero in on the mid-cap stock or Chinese mid-cap stock listed on Hong Kong. Yeah, okay. That gives me more visibility. The company actually doing well. That give me more visibility rather than looking at the smaller Chinese company which provide me less visibility. Yeah, I think as far as downside is concerned, I take the view, being a bit more generous, I take the view that the downside probably is not much to go from here. Okay, but it will take longer to recover. Yeah, so if you want to buy, there are actually good values in Chinese company and Hong Kong companies listed in Hong Kong. So I would prefer to focus on either the big cap stock or the mid cap stock listed in Hong Kong. Thank you. Okay.
Okay, thank you guys. We have come to